June 12, 2026. SpaceX went public, and the celebration has not stopped since. 31%. That is how high SPCX climbed at its peak on day one. From $135 at the IPO price all the way to $176.52 in a single afternoon session. The largest IPO in US stock market history. $75 billion raised in a single day. Every financial headline ran those numbers, like the trade had already paid off, like the only question left was how high it goes next. But here is what almost nobody on financial TV mentioned Thursday afternoon. There is a number buried inside the SpaceX prospectus. Not $135, not $161, not $176. A different number, $175.50. And it is not a price target or an analyst projection. It is a legal trigger, written into a binding document before SPCX ever opened for trading. On day one, the stock crossed that number in live trading. The trigger did not fire, but the countdown has started. This video is about what happens after the celebration ends, what is actually scheduled to occur in the 90 days ahead. Why Elon Musk's lockup looks like a confidence signal, but tells a very different story underneath. And what history says happens when 94 times revenue meets a lockup calendar almost nobody is reading. Everything I'm about to show you is in a public document. Free. 150 pages. Fewer than 1% of retail investors who bought SPCX this week ever opened it. The company versus the deal. Let me say this once and clearly. SpaceX is a genuinely impressive business. In 2025, it launched more rockets than every government space program on Earth combined. Starlink serves over 10 million paying subscribers across 164 countries, generating $11.4 billion in revenue at a 63% adjusted operating margin. The XAI integration adds serious artificial intelligence capacity to the business. Real company, real numbers, real growth. But here is what most first-time IPO buyers miss. A great company and a great investment, at the moment of an IPO, are two completely different things. The price you pay on day one is not set by fundamentals. It is set by the peak of public excitement, which is precisely when the people who held shares for years start thinking about turning paper into real money. SpaceX went public at a $1.77 trillion valuation on $18.7 billion in annual revenue. That is 94 times sales. Amazon listed at roughly 2 times revenue in 1997. Tesla at about 10 times in 2010. At 94 times, investors are not buying present performance. They are buying a very specific version of the future arriving on a very specific timeline. And while investors wait for evidence to catch up, something specific is already scheduled to happen inside the deal structure. The hidden calendar. Nobody read. When SpaceX went public, only about 5% of the company entered the trading float. The other 95% is held by insiders, early employees who waited years to convert paper certificates into real money, founders, and venture capital firms that funded this company across more than 2 decades of private growth, all locked out from selling. For now, most major IPOs use a simple structure. One 180-day lockup. One cliff, one date. Uber used it. Rivian used it. Palantir used it. Brutal when it arrives, but at least every investor can mark it on a calendar. SpaceX built something far more sophisticated. A staggered multi-layer release schedule, 5 time-based tranches, 2 earnings-linked events, and 1 performance trigger that can fire before any of them. Here is the actual calendar from the prospectus. August 21st, day 70. 7% of all insider shares become eligible for sale. September 10th, day 90. Another 7%. September 25th, day 105. 7 more percent. October 10th, day 120. 7 more. October 25th, day 135. The final tranche. That is 35% of insider supply across 5 events between late August and late October alone. But those 5 dates are not the most important events. After SpaceX reports its first quarterly earnings, expected between mid-July and late September, 2 days after that report drops, an additional 20% of insider shares unlock in a single event, larger than any individual tranche, and unlike the fixed calendar dates, the exact timing is not known in advance. Most retail investors will not be watching when it approaches. Then Q3 earnings arrive, expected mid-October through late December. 2 days after that report, another 28% of insider supply enters the market. December 9th, day 180. Final restrictions lift. Do the arithmetic. 35 plus 20 plus 28. 83% of all insider shares released before the standard 180-day lockup even expires. The design is deliberate. 12 separate events across 6 months means no single moment looks alarming enough to generate headlines. The cumulative effect is massive. The individual events barely register. The trigger that almost fired on day 1. Here is the clause that received zero coverage in any major financial outlet this week. Buried in the SpaceX prospectus is a performance trigger clause. If SPCX closes 30% above the $135 IPO price for 5 out of any 10 consecutive trading days before the first earnings report, an additional 10% of insider shares unlock immediately for early sale. 30% above $135 is $175.50. On day 1, Thursday, June 12th, SpaceX hit an intraday high of $176.52. The threshold was crossed in live trading on the very first afternoon of public history. The stock pulled back and closed at $161. The trigger did not fire. The distance between SPCX and that $175.50 line is roughly 9%. Less than one strong trading week of continued momentum. Consider what was driving the buying. SPCX became the most purchased stock in the entire US market on day 1, running 3.5 times more retail purchase flow than Nvidia. Over $100 billion in retail orders placed before the bell even rang. That same enthusiasm, if it keeps pushing the stock toward $175 over coming weeks, is the exact mechanism that unlocks early selling rights for people who held shares for years at a fraction of today's price. Here is the image to carry with you. A dam with a waterline marked on the wall. The water is rising. Everyone is celebrating how high it climbs. Nobody is watching the mark. The pop is the water. $175.50 is the mark. On day 1, the water touched it and receded. The Elon Musk angle. Now here is what every headline got right on the surface and completely missed underneath. Elon Musk committed to a 366-day lockup. He cannot sell a single share until June 13th, 2027. His lockup runs longer than any other insider in the deal. Financial media called this a confidence signal. And in isolation, that is fair. The founder is not dumping shares on day 1. But here is what those headlines did not say. Musk's 366-day lockup applies only to Musk. Every other insider, the early employees converting years of paper into real money, the venture capital firms managing fund timelines and institutional commitments, the executives below the founder level, all of them are on the staggered schedule we just walked through. Their first legal exit window opens at day 70, late August. By the time Musk becomes eligible to sell even one share in June 2027, the rest of the insider class will have had 12 full months of unlock windows to sell into whatever price retail investors built. Musk staying locked protects the public story. Everyone else gets the exits. The retail buyer is the audience holding the doors open for them. The institutional layer, nobody covered. There is one more piece. Most financial coverage skipped entirely. A rule change that took effect just before this IPO now allows companies to join the NASDAQ 100 in as few as 15 trading days after listing. The previous minimum was 3 months, and for companies with a free float below 20%, like SpaceX at 5%, the index applies a 3 times weighting multiplier in the float calculation. SpaceX's 5% float gets treated as 15% in the index math. Over $600 billion in passive funds mechanically track the NASDAQ 100. Every time a tranche unlocks and expands the float, the index weighting increases and hundreds of billions in passive money is forced to buy more SPCX to rebalance. The staggered schedule does not just create exit windows for insiders. It engineers the institutional buyer on the other side of each sale. Insider supply meets passive fund demand. Retail investors fill the gap, buying at prices set by excitement while insiders exit at prices built by that same excitement. That is sophisticated deal engineering, and every piece of it is in a public document. What history already told us. This pattern is not new. Palantir went public in September 2020. The technology was real. Retail enthusiasm pushed the stock from around $10 toward nearly $40. The energy felt like confirmation. Then, the lockup expired. Peter Thiel and other insiders sold directly into the premium retail had built. The stock dropped 13% in a single session. The date was in the prospectus on day one. Almost nobody tracking the ticker was also tracking the calendar. Uber IPO'd at $45 in May 2019. On the precise date the lockup expired, the very first legal morning for any insider to sell, Uber hit an all-time low, 40% below the IPO price. Commentators called it coincidence. It was the calendar doing exactly what the document always said it would do. These were not fraudulent businesses. The pattern was never about bad companies. It was about the predictable gap between a premium set by excitement and a price corrected by supply. SpaceX enters at 94 times revenue, higher than Palantir at peak, higher than Uber, which historically suggests the room between the opening premium and the unlock correction could be wider here than in either of those cases. The investor framework. 3 types of investors are watching SPCX right now. The first buys today. Maximum excitement premium, before earnings, before any unlock events have passed. History says consistently, this has been the riskiest seat at the table in deals structured like this one. The second walks away permanently, decides the mechanics are too complex and never revisits. They may miss a genuinely powerful business at a much more honest entry point months from now. The third marks the calendar, reads each earnings report when it drops, watches each unlock event absorb into the market, and waits for a price built by evidence, not by the energy of the largest IPO morning in US stock market history. By December 9th, 2026, you will have 2 full quarters of real public earnings. You will know whether the $175.50 trigger fired and when. You will have watched 83% of insider supply work through the market. Whatever SPCX trades at on that date is the honest number, not the one from Thursday afternoon. The prospectus is public. The trigger is documented. The calendar is visible. None of this requires special access. It just requires reading the deal before reacting to the headline. Amazon was available for years after 1997. Google after 2004. Nvidia well after its initial listing. The companies that built real wealth for patient investors never required you to buy on day one. The number on your screen today is loud. The calendar in the prospectus is quiet. In 6 months, only one of them will have told you the full truth. I want your honest read on this. Are you buying SPCX right now into the momentum, waiting for the unlock calendar to run its course, or watching this one entirely from the sidelines? Drop it in the comments. I read every single one. And if this kind of breakdown matters to you, subscribe, because Anthropic and OpenAI are both building toward public offerings right now. Same deal mechanics, same calendar structure, same questions, same traps. The next major IPO is being structured on Wall Street today. Make sure you know how to read it before it lands on your screen.